rate buydowns. Interest rate buydowns, guys, this is a big deal. Now, there's two types of interest rate buydowns. Think of one as a permanent rate buydown. That would mean that somebody is paying discount points to buy, let's say, the average interest rate of X to an interest rate lower than that, and that is going to be for the life of the loan. But what we are seeing is temporary rate buydowns becoming still more and more traction. You would think that maybe they are old now, but they're not. Temporary buydowns is something that is still very active in this market. And a temporary buydown is where the seller is going to contribute a certain amount of money that the lender is going to use to buy the interest rate down for the first 2 or 3 years of the loan. The most common temporary buydown is what we call a 2-1 buydown. So let's walk through the math. Let's say that the current going 30-year fixed rate is 7%. Let's just say that. In that scenario, with a 2-1 buydown, using the seller's money to do that, the payment for the first year would be 2 points lower than the actual note rate. So in our example, the note rate 7%. So the first year, that payment's based on 5%. The second year, that payment is based on a 6% interest rate. And then the third and final year, that payment is based on the 7% interest rate. Now, the advantage of doing a 2-1 buydown are twofold. One, there's a runway into that higher note rate if rates never fall to the point where it makes sense to refinance, or maybe somebody loses their job and they're not able to refinance. But two, the monies that are allocated in that temporary rate buydown kind of holding account, those monies just don't vanish, meaning that if that person is going to refinance, let's say in the first year, call it 13 months, whatever balance was left in that temporary rate holding account that the seller paid at close of escrow for this purpose, that money gets credited to the borrower on their refinance. So it's going to reduce their principal balance. So in that scenario, let's kind of walk through it. Let's say that the temporary rate buydown cost was $10,000. And let's say that the borrower has used $4,000 of the $10,000 and they go to refinance. That remaining balance of $6,000 that was in the temporary rate buydown holding account gets credited towards the buyer's principal balance on a refinance. So it's a win. That means that money's not gone. Whereas when you go back to the permanent rate buydown, you're kind of hedging bets, because let's say you're going to pay 2 or 3 discount points to buy that rate down on a permanent rate buydown. Once those discount points are paid and that client refinances, if they're not in the loan long enough to have paid back the cost that they paid for the discount points, then they're out that money. So just from a strategic standpoint, this is a strategy we really like talking about with our agent partners and our borrowers if it makes sense. Now, the one catch here is that the seller has to pay the cost on the temporary buydown. So if that's not the case, based on the seller, the price point, etc., totally get it. But it is something to be considering as you're out there showing properties.